Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I tell you about what's been driving investment markets and what to look out for in the days ahead. Now, we have just crossed over into September after a very tough August for investment managers. Now, I'm talking about professional investment managers. If you go and look at the mixed shares sector, which has a 40 to 85% equity content, then the average fund lost 2.62% during the month of August. Now, that was because there was an increase in trade tensions. Don't forget, Donald Trump threw a trade war tantrum again by proposing to raise tariffs. Some of those tariffs came into effect this week on the 1st of September, but also in August, we had an increased chance of a no-deal Brexit happening at the end of October. Of course, professional managers may have had a tough time, but I personally had a very good month with my own 50k portfolio with 80/20 investor. Now, members will know that I made 0.63% profit during that month. Now, to put that into context, if you look at the 223 fund managers within that mixed sector that I mentioned, 219 of them lost money during August. And that's because they were very growth focused. The reason why I was able to make a profit, despite the volatility, and it's seemingly that professional managers didn't, was because I held REITs, which are real estate investment trusts, some utilities exposure, I had exposure to GILTs and other fixed interest. If you want to know how I did it, then go and take out a free trial on 80/20 investor. So where are we now that we've entered September? Well, we're largely where we were at the end of August. There are no definite dates for trade war negotiations or talks. We've got the new tariffs that have come into effect, and of course we've got the Chinese currency still tumbling. Now, those are the negatives that are out there impacting markets, and they're largely centered around the trade war. But we've also had economic data that's disappointing. We've had some of the worst manufacturing data in years in the US and the UK. In fact, in the US, manufacturing contracted for the first time in 3 years, and in the UK, we had the worst manufacturing data for 7 years. Now, to balance that out, we've had some positives in the last week. So, for example, in Hong Kong, Carrie Lam has actually agreed, or apparently agreed, to withdraw the extradition bill. We've had stability, or some seeming stability, in Italian politics as well. And that's helped push markets up. So we've had a bit of a balance. We are still whipsawing. So if you remember last week, I talked about the S&P 500. I said, go and get your stock market app. You'll see the bounce between around 2850 on the S&P 500 and 2940 on the S&P 500. And we're still range bound. We're still trading with a lot of volatility. And what's happening is traders are coming back from their holiday. So we're getting a little bit more volume in the trades, and markets are seemingly trying to decide whether they're going to break higher or break much lower. And that will only come to light in the coming days and months. Now, of course, we've got the fear index is still where it was last week, around 18, and bonds are still being paid handsomely. So investors in bonds are probably loving this environment at the moment and all the uncertainty, because the US Treasury bond yield for the 10-year is still at 1.47. And of course, gold is still doing very well indeed. The dollar has rallied. It is a haven currency, and that has impacts for emerging markets, which I have covered in previous shows and will come on to in future episodes. Now, for the market, one of the hurdles is payroll data, so jobs numbers in the US on Friday. That could cause a bit of a wobble. So we've still got all this angst with trade, we've got poor economic data, we've got to keep an eye on all those headlines, and obviously what is happening politically in Europe, in Italy, and also in Hong Kong. Now, as a UK investor, you cannot have failed to notice the collapse of the pound. We've seen the pound way down towards 122, 121 against the dollar. Now, this week, we broke below 120 against the dollar. Now, that is a level we've not seen for a number of years. And in fact, the last time the pound traded regularly for a period of time, an extended period of time below $1.20, was back in the mid-1980s, just before Ferris Bueller took his famous day off. Now the impact for your portfolio is that anything in UK large cap, so FTSE 100, had a bit of a kicker from that currency falling, the pound against the dollar and the pound against nearly every other currency in fact. It also meant that any overseas holdings you had got a nice currency boost. So you would have seen that in your portfolio. Equally, anything that was UK focused purely, so you're talking about UK small caps, would have had a little bit of a hit, because the reason for the fall in the pound was of course the uncertainty surrounding Brexit and Boris Johnson trying to fall through a no-deal Brexit by the end of October. And of course we had Parliament try and stop him. So where we are at the moment is British politics is in a mess, and ironically, despite the fact we don't seem to have anybody running this country right now, that was a positive for the pound. So we had a little bit of a pickup. It rallied from 119 back up to about 121, 122 against the dollar. So that was some good news, but it just shows you the volatility that we're going to see in the coming weeks ahead. So something to bear in mind. So again, Brexit headlines are making a massive impact. Expect more volatility and be careful not to be caught out by it. So that is it for this week on Damien's Midweek Market. You can contact me as ever via email, damien@moneytothemasses.com. Of course, you can contact me and ask me questions on Twitter, Money to the Masses with a number 2, and via Instagram. But please make sure you subscribe to our YouTube channel and leave any comments or questions below the video, because I will endeavour to answer them all.